We've got something very unusual going on, but behind the scenes, the price of gold continues to rise. What does that mean? It means there's a party unknown who is increasing or buying into the futures and asking for delivery. Someone somewhere is asking for delivery. Now, if you look at the deliveries that we've seen in the month of February, the delivery notices, it's off the radar screen. So something very, very odd is going on in the gold market. Looks like something is breaking, but we'll have to wait and see what's going to, if there's something we don't know.
Whoever has the gold makes the rules, a timeless adage now being dramatically tested. Three major players in the global gold market, the London Gold Exchange, COMEX, New York, and the Shanghai Gold Exchange are at the center of an unfolding shift. In an unprecedented move, 400 tons of physical gold, valued at a staggering $40 billion, has been airlifted from the vaults of the London Gold Exchange to COMEX-approved depositories in New York. This massive transfer from the world of physical gold, LGE, to paper gold, COMEX, signals something extraordinary. Adding to the intrigue, COMEX traders increasingly demand physical delivery of gold, a rare occurrence that hints at growing market anxieties. Clive Thompson, a veteran wealth manager, has noted that something highly unusual is happening behind the scenes. Despite price fluctuations, gold continues to rise, suggesting that an unknown entity is aggressively buying futures and insisting on physical settlement. Meanwhile, in response to President Donald Trump's proposed tariffs, major banks are relocating gold reserves from London to New York to capitalize on price differences. Since early December, gold prices in London have been approximately $20 per ounce lower than in New York. By moving gold across the Atlantic, banks can offset potential losses in the futures market or secure higher profits through new contracts. JP Morgan Chase and HSBC are at the forefront of this strategy, with JP Morgan alone shifting approximately $4 billion worth of gold in February. Thompson sees two possible explanations for this sudden surge. First, some investors may preemptively relocate gold to New York amid uncertainty surrounding Trump's tariffs, even though direct gold tariffs remain unlikely. The second, more compelling possibility is a strategic accumulation by a significant global entity. Speculation is swirling that China could be the mystery buyer, yet some analysts suspect the Federal Reserve or U.S. Treasury may be behind the move. Whatever the case, the rapid shift in physical gold suggests that the stakes in the global financial system are rising fast. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
We've got something very unusual going on, but behind the scenes, the price of gold continues to rise. What does that mean? It means there's a party unknown who is increasing or buying into the futures and asking for delivery. Someone somewhere is asking for delivery. Now, if you look at the deliveries that we've seen in the month of February, the delivery notices, it's off the radar screen. If I go back to a normal delivery month, if we go back to February 2024.
I think in one of your messages, I saw delivery notices are up 177%.
Well,
compared to February of last year.
Yeah, it's now, you're right, it's now 255% up.
Oh my goodness.
So the deliveries in February 2024 were 20,754. That's in February 24. In February 2025, we're up to 73,624. That's, as far as I can tell, I've only gone back a few years, but it looks to me like an all-time record in deliveries. We've never seen COMEX investors demanding delivery of so many bars. We don't know who they're going to, but those bars are being delivered, and someone somewhere is getting them, and what they're doing with them, we don't know. But we've gone from, as I say, from a normalized 20,000 in February to 73,000. If I just run through the major delivery months from last year, and I'll do it month by month. So I'm starting with December, going through to December this year, 15,000, 20,000, 18,000, 30,000, 22,000, 12,000, 25,000, and suddenly February, 73,000. So you can see the huge leap. It's completely off the scale and completely abnormal. So, we don't. we don't fully know why that's happening. Of course, there's an arbitrage to be had, and the banks are taking advantage of it, the hedge funds are taking advantage of it. There's two things which could be going on. First of all, Trump has threatened to impose tariffs. I don't think they'll be imposed on gold. There's absolutely no reason whatsoever to put tariffs on gold or silver, because the reason you put tariffs is to protect the local industry. Now, the gold industry in the United States doesn't need protecting. It's not like China is dumping gold on America at half price.
Yeah.
So there's no reason to put a tariff on gold at all. You're not protecting the local industry, and it's not a nascent brand new industry which needs protecting either. So the only thing that tariffs on gold would do would be to increase the taxes for the United States. Of course, that would put up the price of gold. But it's unlikely to happen. But people have said, maybe the trigger for this was people said, I better get my gold into New York before it's too late. But logically, that should have suppressed the price of gold in New York, not made it trade at a higher price than everywhere else, which is what we're having.
Right.
So it doesn't. So saying that it's people moving gold to New York because they're worried about tariffs, it could be the catalyst. But someone somewhere is now taking that delivery and they're taking that gold. So, in simple terms, we've gone to a record level of deliveries of gold in the month of February. Someone somewhere is taking delivery of that gold. We don't know who it is. My suspicion is it might be China, but there are rumours that it might be the Federal Reserve, it might be the Treasury. Obviously, there's some questions being asked as to whether the Treasury has got all the gold that it says it has. I have no reason to suppose that's not correct, but there's a lot of people who suspect it's not there, and there's a lot of rumours out there, and they're going to audit it. So what we've got is the problem of getting the logistics of getting the gold, the 400-ounce bars from London to New York, converting them into 100-ounce bars to be delivered, because nobody ever expected that to happen. The futures traders, the ones who are selling short, just expected that they continue to roll the futures one after the other, and if the push came to the shove, they could ask London to deliver the bars to New York, and it would arrive in 2 days, and everything would be fine. But here's the problem. Those bars aren't arriving, and the price of gold is rising because someone somewhere is asking for those bars. Now, it could be a short squeeze. People are saying, right, someone's got a problem, they haven't got the gold, let's squeeze them. Let's demand delivery of gold they haven't got. And that forces them into the market to buy back the spot price. But logically, if that was the only thing that's happening, they'd be buying back the spot and selling the future, which would mean the premium of the future wouldn't exist anymore. But the premium is still there. So something very, very odd is going on in the gold market. Looks like something is breaking, but we'll have to wait and see what's going to, if there's something we don't know.
As U.S. debt spirals out of control and central banks race to reclaim their gold reserves, the risk of a gold shortage becomes increasingly apparent. With gold skyrocketing 44% in the past year, from $2,024 to $2,899 an ounce, the prospect of a significant gold revaluation is once again in the spotlight. The convergence of extraordinary forces, the accelerating gold rush, a global wave of repatriation, suspicions of market manipulation, and surging prices, suggests a seismic shift in the financial landscape. According to Clive Thompson, if the U.S. government were to officially revalue gold, raising its book value from $422 per ounce to the prevailing market price or beyond, it would establish a new price floor, ensuring gold never trades below this threshold again. Such a move could send shockwaves through the global monetary system. Thompson further argues that political narratives about Trump, tariffs, or China are distractions from the real force driving gold's ascent: mathematics. Now let's redirect our attention to a video.
At the moment, there's a mathematical reason why the spot price of gold is being pulled higher. And that mathematical reason is that the futures are at an unusually high level. So when the futures trade at a level which is higher than the gold price, that's called a contango.
Yes.
And as you approach the settlement month, or the final day of the settlement month, that contango drifts down from, let's say, $10 or $20 towards zero, and ultimately hits zero on the final day of the contract. But what we've been seeing is a contango where the futures price is at a much higher price than would be expected according to what's called the cost of carry. And the cost of carry, as far as gold is concerned, is, to all intents and purposes, the interest rate on a 3-month Treasury bill, or it should be. But this time, it's not. it's much, much higher. So what's happening, therefore, is that people are saying, if I can lay my hands on the right size bars, I can buy the spot bars, sell the future, and make a contango, or make an interest rate return, which is far higher than I can get on any other asset, and there is zero risk. Because I own the gold, when it gets to spot month, I can deliver the gold. Zero risk. So the question is, how high can it go? Well, I think you never know. The music carries on until it stops. But right now we have a clear situation that there are net buyers of gold out there. And I think this is now starting to draw in, to a small extent, asset allocators from the big banks and investment managers who are starting to say, I've had a really good run with my Mag 7, with my S&P 500. Is it time to take a little bit of money off the table and go into the next big thing? And I think that some of them are starting to allocate 1 or 2 or 3% to the gold market. And that, I think, is also, it's still very, very early. There's no evidence that that's happening yet, because we don't see large inflows into the gold ETFs. But I think it's starting to happen a little bit. They're picking up gold a bit left, right, and centre, and it's probably more in Europe than it is in America. But people are starting to buy that gold, and I think it could, down the line, turn into quite a rush. So we might see a huge speculative move upwards in the price of gold. So how can it go? Well, Daniel, I don't know. I mean, you can put any number under the sun. You know, things can go to extreme levels when people get excited about something. The gold market, relative to other things, is a relatively small market. So in terms of what's available to be sold at a certain price, because the central banks aren't going to be selling their gold at any price. So it could go quite a long way. If this plan by Besant to monetize gold goes ahead, and when I say monetize, what that means is they would revalue gold from the official price of $42.22 to perhaps the market price, or let's call it $3,000 or $3,500 maybe, which is higher than the market price. What that would do would put a new floor under the gold price. So let's just say, for illustration purposes, the government decides to do that, and I'll tell you why they'll do it in a second. They revalue gold at a new official price of $3,500. What does that do? It puts a floor under the gold price, because the government is now standing ready to buy unlimited amounts of gold at $3,500. So you have no risk whatsoever if you buy gold when they've made that the official price, because they will buy unlimited amounts of gold at the official price. Of course, they won't sell you any at the official price. The question is, why would they put a new price on gold, a new official price? Well, the reason is, if you change the price of gold from the $42.22 that it's on the books at the moment to the market value, they are going to book a very large profit. So if they put it to, let's say, 2,900, where gold is roughly now, then that's about $800 billion of profit, which, by calling it a profit, they can say that the budget deficit for the current year, at least, has been reduced. So if they were to do this, the higher the gold price, the better. Because the higher the gold price is, the more profit they're going to make, and the more they can say they've reduced the budget deficit. Now, it doesn't actually change anything about, as far as the amount the government actually has to borrow, but it does make the official figures look much better than they really are. And of course, then President Trump, can stand up and say, look, I've only been president for a year or 2 years, whatever it is. And look, the deficit's down from $2 trillion to $500 billion or $1 trillion, whatever the figure will be.
A full-scale gold rush is unfolding. As of January 2025, China's central bank has amassed an astonishing 2,280 tons of gold, valued at over $200 billion. Meanwhile, Russia, Poland, Singapore, Turkey, and Libya have aggressively expanded their reserves, seizing every opportunity to acquire the precious metal. But perhaps the most intriguing move comes from India, which has discreetly repatriated over 200 tons of gold from the Bank of England's vaults. This quiet yet dramatic shift raises a pressing question. What does India know that the rest of the world doesn't? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated. Thank you for being a part of this journey with us.